All right. Good afternoon, everybody. Check, radio check. I want to thank everybody for taking time out of their busy schedules to hop on a call with us. This is, again, for those of you that have not been on this call before, we are live streaming this. And, I'm your presenter, your host today. And since COVID hit, we try and do a rear view mirror look of what happened. So although the slide is March 2023, what has happened in the markets in February or year to date. And this sort of gives us, gives us the ability to sort of step back and not get caught up in the day-to-day news. Although important, one of the things that we feel at Professional Planning Services is that you cannot be emotional or reactionary. Obviously, we are constantly aware of the news and changes to data points and global events. All of these things are obviously worth consideration. But part of working with an advisor is having the ability to have strategies so that regardless of what goes on in the world, a well-rounded plan can help you to survive volatility like today, right? So without further ado, this call takes about 15 minutes when I do these updates, and at the end I'll touch on some other points. But without further ado, let's look at how did equities do in February. So equities in February, if you were to just look at a more of a micro level, not its best month. And I think all of us, if you opened up your 401k or your brokerage statements, saw some stress on the equities, and it can cause a lot of tension. What's going on? What should we be doing? And and this is why you have to be careful, because again, the talking heads, those are the people on your CNBCs, your economists, your people that are promoting equities, or the expert of the week or the day, right? That quite often, although what they're saying may absolutely be true, it may not may not be complete in its entirety, meaning that you can't make large decisions based on one daily event. And many studies have been done that, if the economy does correct X amount, that where investors quite often miss some of the 14 best days in the year or in a period of time, and that is because they are out of the market when it recovers. So, that's where I will always come back to having a strategy, having a plan, monitoring and reducing risk along the way. So what you see here is, again, color-coded chart. For those of you that are not familiar, the blue chips, the baby blue, is your small chips. This is your local, Russell 2000 is small cap companies. These are your mom and pops, they're just not your giants, right? This is what I really feel is the heartbeat of America. This is Main Street USA, and they are challenged. But out of all the places to be for this month, they didn't do too badly. And then as we continue, the S&P, which is top 500 blue chip stocks, more of that red, white, and blue value added, name brand, household recognized names, that falls under that purple. And then the teal green is developed countries in Europe. The rest of these, I'll show you on the next slide. But I just want to point out that out of all these economies for the month of February, emerging markets did the worst, right? I tend to view emerging markets, or I think about it in my mind as China, right? Indonesia, right? Just countries that are trying to get back to more of a stable economical and financial arena. So now when we talk about year to date, so again, this is only 2 months, but you'll start to see that in a 2-month period, it's a little bit better, right? There's a little gleam of hope on the horizon compared to last year. So again, small caps, Russell, Main Street USA for the month of February or year to date did better, right? And this is why, the Americans and American entrepreneurs and business owners are resilient, right? They're going to, they sometimes they take it on the chin, and that typically comes with political risk or governmental legislation or restraints or rules, regulations, very similar to what happened in COVID. They really got hurt. But now people are starting to come back and spend there. And then developed countries in Europe. Europe is starting to see a little bit of blossoming as well. Now, dark green, that was real estate. Again, for the year right now, compared to last year, doing a little better. And now we have purple, which is blue chips, your S&P. The China economy, emerging markets, that's a little bit above average. And the two areas that didn't really do well, commodities, right? And then we had the Dow Jones industrial averages. So, I'm just reading to you what the data is showing. And again, this is so that the reason we do this is so that we don't make knee-jerk decisions as we look into the future. Now, this chart here, three wise men, basically what I see here is that there are two areas, that middle line, the moving average crossover, it's close. But the one on top, the RSI relative strength index, has been sort of a sidebar, right? It's not doing too much one way or the other. So you don't see it crossing over that top line or bottom line. So there's no reason for a reversal, at least immediately on the horizon. And then on the bottom one, which is the MACD, moving average convergence divergent line, these are technical indicators that allow just basically to have some point of reference. Think of it like a bellwether, or, maybe if, we were looking at a compass, what direction do we want to head, or what direction do we think things are going? This sort of gives us an indication as to where the economy is going. So this is just one piece of data that we look at as we're dealing with our clients, and we're offering suggestions on what to be aware of. So you've seen this before. Things look pretty, normal right now on this slide in comparison to past months. But now we're going to switch over to income. Income is, all right, we've approached retirement. We can't afford the risk of equities. We have lesser holdings in equities. But now I've switched over to some type of income portfolio. How did February look? Not good. Right? So income, right, doesn't like rising interest rates. So we've seen that, this is going to be an area that will continue to be a challenge until we figure out how to control inflation. And there's a lot of moving parts here. There's a lot of data to take into consideration. I don't have all the answers, right? I'm just telling you that when we're advising our clients and we're saying, hey, listen, this is what to be careful of, right? That inflation, you don't need me to tell you that things cost more today than they did last year. I was just looking at some data. Inflation for the month of February was 6%. And you go, it's not too bad. I mean, I build into my models 3%. But you go 6%, I guess that's not too bad. Compared to last year in February, it was 9.1%. So it has come down. But when you take 9% last year and 6% this year, I mean, that's where things, I just go to the grocery store and my litmus test is like, hey, listen, how much does a box of cereal cost? Things on the shelf. Are they doing something called shrinkflation, which is where we're getting the same packaging, but it's in a smaller box, or the internal weight is actually less, right? There's more air in that bag of chips, right? So these types of things are way corporations can pass along the increased costs without really the consumer noticing it completely, right? But at the end of the day, on 1 month, we go, look, this is not ideal. And then you'll see treasury bonds, right? They didn't do well, and people tend to fly there for safety, but that's the least popular for the month of February of all the indices. But as we look at year to date, right, treasuries did a little bit better, right, than everything else. So, this is just saying, if I look at this and I go, look, I got $1 million and I need my portfolio to throw a 4%. None of these strategies are working. So now you're eating into principal. So 4% of $1 million, 40 grand. If I need 40 grand to fill that income gap, right, where's that money come from? Right? If you worked with a planner or somebody to help you to fill that income gap, where's that money come from? And if we have lesser than desired returns, And that's what the problem with using averages, right? So when we're strategizing and we're trying to come up with, bond alternatives or income alternatives or things of that nature, we have to look at the whole picture to make sure that we're not overly exposed to government risk, to inflation risk, to just market risk, all the things that we've talked about, tax risk, right? That these are all parts, especially like I said, when we approach retirement, we have to be cognizant of these variables. And that's why quite often, as I see you getting into your 50s, 60s, ultimately 70s, you'll see that I start to dial back in the areas that I'm comfortable with sharing with the client. I had an advisor yesterday or the day before send me a profile that they're out of North Carolina, and they sent me another advisor had put this client, 57 years old, and they'd been working with this guy for a couple of years. And when I looked at their risk score, I mean, they were doing 82 miles an hour down the highway. And the client's, comfort level was like 50. And I'm like, that's what quite often people are, and typically the answer that an advisor will give, well, it'll come back. Well, if you're not a seasoned advisor, how do you know? Like, how dare you? How do you, if you haven't been through 2000 or 2008 or even some of the flash crashes in the last decade, right? How do you take that kind of risk with the client's portfolio? So I was a little alarmed at that. So again, crossover points here. The bond picture tells a little bit story that it looks like we may be approaching a crossover. We still don't have a green line yet, though. So these are just all things that we're looking at. And now what I'm going to get is the thing out of all the data that we've looked at, the thing that I've been talking about for a while. And it's not to say, hey, the sky is falling. This is not Chicken Little, okay? But it is data. And it's 100 data points, and 50 is the baseline. And, all through COVID, and for a little brief moment, we crossed over 50, but only in the last year have we gone across 50. And this is a recession probability analytic tool, proprietary algorithm that was designed by Formulafolios, then acquired by Brookstone, who's my RIA. But all that means is that, to me, 91 is really, really high out of a possible 100. So you could say whatever you want to. We're not in a recession. Oh, it's only a transitional. Listen, you can talk and have lip service all day long. The data doesn't lie. And I think things on the horizon will continue to be challenged for a while. So as we put our money into the markets, or we invest, or we have where should we be? It should be thoughtful, not reactionary, but thoughtful, right? But all my gadgets on my financial GPS, if I was the pilot of the plane, I got blinking red lights. I'd be the captain coming over the loudspeaker saying, hey, listen, we're going to be hitting some turbulence up ahead. Please stay seated and put your seatbelt on. That's what I would be saying. So, and it is not an opportunity to scare you, because I gain nothing by doing that. I am not a fear monger. But would you prefer that the captain not say anything and have you walking around the cabin and say, oh, it's okay, don't worry about this, normal? BS, right? There are things you can do to protect yourself, to make sure during turbulent times that we're not flying up out of our seat and getting injured and hitting our heads on the ceiling. I'm not saying the plane's going to crash, but that's the best analogy I can come up with. So that's my 2 cents for this month. Sorry to go down a rabbit hole a little bit, but this is what I see and this is what's happening. So, again, if you got questions, you got comments, you got things that you'd like me to take a look at, I'm happy to do so. Now, the last couple things I want to say here. We got some events coming up, public, that we haven't done in almost 3 years, I think it's been, right, Caitlin? I got a Medicare Made Simple coming up next month, right? It's a live event. You can go on our website and you can register. I go to professionalplanningservices.com, go to upcoming events, and you can register. Seating is limited. I think that room only holds 50 people, and our mailing is going out in about a week. right? So once that happens, it's going to be first come, first serve. You guys are getting first dibs. So that's the first thing. Second thing is long-term care. Now, I want to say that, I am an advisor, and nothing gives me greater pleasure to be able to work with a client. I just had a client retire last week at 57 years old. He went through, I helped 3 of his kids get through college. We paid for it without going broke. He ended up getting laid off, and then he got another job. And as we're looking at his overall model, he followed a lot of my advice. I would say almost 100% of my advice. And you're good. You're good. The only area that I told him I want to circle back on that we now have to put in place, and this is typically my philosophy. I'm not pushing product. I'm a financial planner. I got a lot of letters after my name. I've been doing this for over 30 years, right? This is not my first rodeo. I'm not going to tell you what you want to hear. I'm going to tell you what you need to know. But quite often, the reason I don't approach long-term care more aggressively is because I already know what the answer is going to be most times, or until I'm very confident that we can get through the cash flow portion of retirement before I start allocating resources towards a long-term care solution that may or may not come. Now, statistics show you got a 50% if one of the two of you make it to age 85 that you're going to need long-term care. And then the question is, if you're going to need long-term care, where do you want to be taken care of? You want to be taken care of at home, or you want to be taken care of in a nursing home? Most people are going to pick a house. Okay, so now you're home. Who's taking care of you? And which asset do you want to use to pay for it? So this event, now that I'm, just really gung-ho, and you're going to hear me talking a lot about it, is the single greatest thing that I think can upset or upend a well-planned retirement plan. So even though this, and I told him, I said, I'm still smiling by the news that he's retiring at 57. He and his wife, 3 kids, college done, everything's done. But we don't have a long-term care solution in place. So I said, we need to get together. And it will be, here's the thing that I've learned, and especially of recent, there are solutions now that weren't available 5 years ago, 10 years ago. So, you'll hear me start to say this from the cradle to the grave. It doesn't matter if you have somebody in a nursing home with Alzheimer's already, we probably can help you to add value to the dollars that you're spending already. So everybody's circumstances are different, but you'll hear me say from the cradle to the grave, we have solutions. So that event will be live also at Mercer County Community College. I do not have a link ready for that. And that's because it's still, 3 months into the future, but we are putting that together. If you think you might want to learn more, attend, know somebody that's experiencing long-term care needs or whatever, you need to be at this event. It's let me show you. Like I said, at the end of the day, if you got to pay for it, and somebody's going to, whether it's be a home healthcare assistant, whether it be you go into a nursing home, whatever that number is. And I've gone through this with clients of mine, and I've seen it firsthand how it starts to wipe out the estate and all their net worth. Which pocket, which pot, which asset do you want to use to pay for it? You want to use your home? You want to use your IRA? You want to use the cash in the bank? You want to use your income from your spouse who's now not working because they got to take care of you? I don't know. But we're going to talk and have the real adult conversation about the risks that most people know that they need it and want it, but they don't have an answer to it, so they ignore it. And the ostrich approach does not work. So that's my soapbox. I'm sorry to go off on a tangent there, but it is that important in our planning on an overall future. So folks, everybody, this is my last slide, my little transition. So I'm going to shut up, and I hope all of you, reach out if you got questions.